Hi, I'm Jame DiBiasio for AsianInvestor. With me to talk about the alternatives industry in Asia is Peter Douglas, who is a long-time experienced hedge fund consultancy and also now the Singapore director for CAIA, which is an organization that helps develop and train people in the alternatives community. Peter, what's happening with the funding that's going into hedge funds and other alternative strategies from Asia? Is the money starting to come from Asian asset owners or Asian families, or is it still primarily coming from the United States?
United States and Europe. I'd say there are limited pockets of capital across the region that have appetite for Asian hedge funds. Some of those would include the sovereign wealth funds here. The private wealth, which historically has been the anchor, in particular of the boutique industry, is largely absent from hedge funds, although conversely, I think over the last few years they've become more active in seeding Asian hedge funds. But generally, the story, as it has been for the last 15 years, is that to be successful, an Asian hedge fund needs to raise capital from outside the region.
Do you think that will change? Is there a dynamic at play? You talked about the seeding side. Could we see maybe 5 years from now a different conversation, or is this a long-term structural reality?
I have to say, given that I've been asked that question every 5 years for the last 15, I have a horrible feeling it's a structural reality.
Okay.
It's hard to see why most Asian capital owners would want to invest in strategies which in aggregate will give them a lower return than public markets in return for lower volatility. Most Asian asset owners are perfectly comfortable with volatility and feel, rightly or wrongly, that they can find better returns than they can see in public markets. So I suspect this is structural, certainly for the rest of my professional lifetime.
Okay, which I assume will be very long indeed.
Oh, you're too kind.
And I had a meeting with some sovereign wealth funds recently, and this was in Hong Kong, and they were talking up liquid alternatives.
Yeah.
They seem very keen on adding these to the portfolios, exploring these. What does that mean for regular hedge fund managers or indeed deliberately illiquid strategies in the private equity space? Are they getting pressure from this in terms of being able to raise assets?
Yeah, look, I think the first thing to realise with liquid alts is that the liquid alternatives are not really a new strategy. It's a structure, it's a packaging, and it's bringing a given investment strategy to a new audience that needs a liquid or a more regulated structure. So it's important to understand this is not a new asset class. And some hedge fund strategies lend themselves very well to being packaged in liquid alts and some less so. I'm not sure at the opposite end of the liquidity spectrum there's a great deal of pressure. I don't think any private equity or real estate or infrastructure investor is going to expect to see their asset class wrapped up in a UCITS or an OIC. I think the issue is in those sort of middle liquidity strategies, and from the regular hedge fund manager, you describe the regular hedge fund manager's point of view, it's an important business decision now as to whether their strategy will naturally fit in a liquid alternative bucket, because if it does, that will broaden the audience hugely.
And if not, then they need to make sure that they do very well indeed in their niche.
Always a good success strategy.
Yes, okay. Should we be careful not to confuse liquid alternatives and these structures with replicators, low-cost, sort of beta-like tools that are meant to replicate a hedge fund return for a lot less? What do you see as how much success are those having with asset owners here, and in general, are they living up to their promise?
I don't see a huge appetite from asset owners here, although personally I find them very helpful, and we've used replicators in the past because whereas you're always looking for excellence, in particular in the alternative world, at least in principle, is in search of alpha. And yeah, so therefore, why would you want to beat a product? Well, you'd want to beat a product as a place marker, and therefore for temporary allocations, for rebalancing, we find these very effective. And arguably, one of the effects I suspect of this move towards liquid alternatives is that it's going to increase the pool of fairly generic hedge fund returns. And when you have a pool of generic asset returns, well, that does start to argue for an indexed approach. So specifically now, do we see a great deal of demand? I'm not sure I do. Will these products become much more important for asset allocators generally? I suspect they will.
Is that having an effect on the fees that hedge funds can charge today?
I think the fees that hedge funds can charge are moving quite rapidly anyway. I'm not sure to what extent I'd attribute that specifically to replicators, but 2 and 20 may well be the headline on the packet, but the industry in aggregate has been seeing fairly steadily decreasing aggregate fees really since the financial crisis. But that's driven much more by the increasing importance of major big ticket investors so the balance of power is shifting. It's driven by the move towards separate accounts as opposed to commingled funds, which are always at a negotiated fee, and it's driven by the growth of seeders and accelerators who will provide investment capital at a fee which reduces the aggregate.
Right. And is performance, broadly speaking, obviously hedge funds come in many shapes and sizes, all kinds of asset classes, but do you find that is performance at an aggregate level justifying those old fees, or is another driver of reduced fees the fact that performance often on a net fee basis has been less than rosy?
I think professional investors are running the slide rule very carefully over the relationship between the returns and the volatility and the fees they're getting, and I think that equation is under a great deal of scrutiny.
One last question for you, Peter. What strategies, I know that you're not an investment an analyst, but do you have a sense of what strategies are probably going to be working very well for investors, at least in the first half of the coming year? It seems to be hot.
I hate those crystal ball questions. We would, for several years now, we've been big advocates of activist equity investing in Japan. I think that will continue to be powerful. I think in a world of continued market liquidity, obviously the long-only strategies will do well. And in Asia, where benchmark investing is generally not a success, I think the non-benchmarked stock-picking long-only strategies in Asia will continue to do well. And finally, we would continue to be in favour of the bank substitution strategies. So funds and hedge funds moving in where banks are moving out. So direct lending, pre-IPO, eating the bank's lunch for them.
Great. Peter Douglas, thank you very much.